we saw yesterday from Alphabet or from Tesla.
Yeah, so I'm a shareholder in Alphabet. Let me just tell you, you cannot say CapEx will be up 91% with revenue growing 12%. Nobody wants to hear that. And that's why you got the reaction you got. Ruth Porat also said they're going to throw another $5 billion at Waymo. Nobody's excited about that either. You have an ad market that is strong but stable and not accelerating. YouTube was a little bit softer than people would have liked. And AWS just requires this massive CapEx increase quarter after quarter. And look, we have said this on this show consistently. The number one risk to the stock market this year, we've been saying this since January, and by the way, I don't even know what number two is, not the Fed. The number one risk is people's the sentiment around AI cooling off, and not just stock trader sentiment that affects prices, but CFO sentiment towards spending. The good news is it is a circular spend. All of these big, highly liquid mega cap companies have a lot more to lose than to gain by slowing down, so it doesn't look like they want to just yet. But if investors start demanding that they slow down this CapEx expansion via selling shares, it could catch the attention of these C-suites and force a little bit of chastity, similar to what we saw in 2022. The earnings growth that we're expecting market-wide is heavily predicated on this mega cap circular spend continuing, so we're going to need that to happen. So again, it's not dire, it's not the end of the world, but I think we got a really nice wake-up call this week. For anyone that forgot, this is what's really driving the tape this year. The other wake-up call we got that was more important, Frank, and this is the one that I want to spend a second on. Diversification. We have a saying at my firm, Ritholtz Wealth Management, diversification means never having to say you're sorry and always having to say you're sorry. You will always have stocks, asset classes, geographies, whatever, that look terrible while, you know, some other asset class is rocketing higher. And there's always this tendency from investors to say, well, why do I even own any of that? Why do I have 10% allocated to, name it, small caps, mid caps, Europe, value, whatever? There's always going to be that. But this week was a reminder, oh, that's why. Because trees don't grow to the sky, and there will never be a style or strategy that relentlessly goes higher forever without taking a pause. If you were 80-90% mega cap tech this week, it's not been fun. If you had a diversified portfolio, let me tell you something. This was the first 2% down day in the S&P since February of 2023. It is the best possible way you could be down. We had 4 sectors higher while the market was down 2%. That hasn't happened since 1990. You had 1/3 of stocks in the S&P 500 yesterday were green. That almost never happens. It is the best breadth on a 2% negative day for the S&P 500 since October of 2000. So this should be a wake-up call. If you're not in these other sectors, if you're not diversified, it may seem like the right thing to do. It isn't.
You're talking about circular